Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Really excited for today's show. We've got none other than Brad Johnson on with us. Brad, welcome to the show.
Hi, Brian. Thanks for having me on.
Yeah, no problem. Just for everybody else, we'll make one small explanation. Yeah, the title is Diary of an Apartment Investor. Brad does mobile home parks, which is technically multifamily. So that's the lead in here. But that said, Brad, tell us a little bit about yourself and how you got into multifamily.
Sure. It's like a horizontal apartment building, Brian.
Yeah,
It's
I,
very,
I mean,
very flat.
it's a thin line between, what an apartment is and what a mobile home park is, right? So,
Yeah. So my background is more on institutional real estate is how I kind of started my career. I was working for a real estate investment bank in San Francisco, big skyscraper, working crazy hours. And I had my first kid and I was showing pictures of my boy to a bunch of people and they were all of him sleeping. So I
mhm.
was working insane hours, never seeing my family. And I was like, well, this isn't that fun. So I was looking for a niche, something that, I could pitch to investors, I could pitch to partners that was unique because I wasn't the 50-year-old with a giant track record in
Mhm.
apartment buildings or office towers or industrial. I thought I needed something quirky. And so I was looking for something unique. And I came across, I had this in the back of my head, mobile home parks,
Mhm.
just because I heard about them a long time prior. And then I had seen some information about how well they do in downturns
Yep.
and how they generate high cash flow yields, but yet don't have very high default rates. And I was like, that's interesting because that data shouldn't go that way, right? It should be the opposite. So I plunged into buying parks with a partner, got up to 2,300 pads over 5 years, over 100 million to put to work, and then sold
Nice.
that portfolio in 2020 because I couldn't buy anything. The math wasn't mathing for me anymore
Yeah.
on purchase pricing. So I don't know if we top ticked the market, but we got a little lucky in our
Yeah.
exit timing for sure.
You came
Um,
close.
Came
I think,
close.
yeah, multifamily in general peaked early 22. So you came really close selling in
it
2020.
it's funny because for about a year I was like, why did I sell? So but we decided my business partner and I had a friendly disagreement on how we wanted to spend the next 30 years. And
Hmm.
so he was just like, let's keep going as is, which
Hmm.
I was partly on board for, but I was also running the property management team with roughly 30 people. And I'm more of an investor at heart. I'm more of an allocator. I like partnering with groups that are the boots on the ground. So that's what we've morphed into is I am now the gray hair on the team,
Hmm.
adding some capital, adding some hard-earned experience, and then helping them put together deals, and then also bringing our investors into deals that I like
Yeah.
and want to put our capital in.
Awesome. 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 So, that sounds like a lot. So 100 million, and you said 2,300 pads is what you guys had prior to making the shift. Let's go about the question. I'm glad it was a friendly disagreement, first of all, but if I remember correctly, you said he wanted to continue doing things that he wanted to do, and you wanted to pivot a little bit. Can you go a little bit deeper into your reasons why? And
Yeah.
yeah, just that, reasons why.
Yeah, I mean, I don't know if your listeners know how intensive property management actually is, right? Like it is tough if you have not had experience with it. And it is very unique in our world of mobile home parks because we
Hmm.
cannot just hire a third party property manager. We had to build out from the ground up a property management
Hmm.
platform to be able to just, besides just babysitting the assets on the stabilized ones, but really lay out the business plan and effectuate the business plan.
Hmm.
So, it'd be nice to just, hire one of 30 property management groups in the town, but that didn't exist.
Yeah.
So I found myself doing work that it didn't light me up. It wasn't
Mhm.
kind of in my core skill set. I was serviceable at it, but I couldn't envision doing that for another 30, 40 years. And
Mhm.
so I wanted to be able to set my next phase, right? The first phase went very well. So the next phase, I wanted to be able to set myself up to do it for 30 years and do work that I love and am good at. So yeah, so now we partner with groups, which also I think is helpful from just a deal flow standpoint,
Mhm.
right? Our world is not as large as your world, right? We only have maybe
Yeah.
10,000 parks that I would want to invest in.
Yeah.
And if you can imagine, not very many of those are trading at any given time because
Mhm.
some of these owners really like the cash flow and don't want to sell. So it's a smaller buy box for us. And so I like to partner with groups all over the country because we see a lot more deal flow that way.
Mhm.
Whereas maybe some of our partners only see a couple, two, three deals a year that they end up doing, right? We
Mhm.
times that by 15. So we
Yeah.
we we get to see a lot more, which I like.
Awesome. So you're partnering with the operators, and sounds like you're mostly bringing funds to the partnerships. Is that accurate?
Yeah. So we've stood up two platforms. We're working on a third. The first two were about 20 million in equity. The third
Mhm.
is looking to be a substantially larger, maybe 100 million of equity. And it's just kind of getting those operators to the next level, right? Because
Mhm.
they started off just passing the hat around with their friends and family. They get a little investor base. They do maybe 10 to 20 deals, right? But then they get to the point where they decide, do I want to continue this as is, or do I want to kind of level up and
Yeah.
really scale and get my team much larger?
Mhm.
And so we've helped out groups do that. And then we've also helped out, the groups that, hey, we're short a few million on a deal.
Mhm.
Let's call Brad and he'll help us, close the
Yeah.
rest. And so we'll raise a specific SPV and we'll put our capital often at preferred terms that we're passing through to our investors because we're coming in wholesale in a way.
Yeah, yeah. I mean, you bring a larger chunk of money and you can negotiate, a lot better deals. That's kind of how that works for most deals. So,
Yeah, and we're not commodity capital in that.
yeah,
I know the operators. I've known them for a long time. They know that I was an operator in the space,
yeah.
and so we bring some other bells and whistles to the deal besides just cash.
Okay. Nice, nice, nice. So, speaking of just the cash and the environment we're in, what are some of the challenges you're seeing right now?
Yeah. Oh, I imagine very similar to what you're seeing on the apartment
Hmm.
side with debt. Debt is
Yeah.
a big challenge right now. We tend to solve that through just taking on low leverage, and maybe there's a layer of pref, or maybe we just are comfortable with 50% LTV and we're just taking a
Hmm.
lower risk bet and with the intention of refinancing in a few years. Right?
Yeah.
So that tends to work in our space because when you're
Hmm.
buying from mom and pop, they generally have not kept pace with inflation on lot
Hmm.
rents. We got to do it responsibly. We can't just go in there and double rents, right? But we can go in there and methodically raise them, 5 to 10% pretty reliably in most markets. And so that is a good combo, especially if you're adding some homes to a property or expanding it. That's a good combo for a refinance.
I know it's different getting debt on mobile home parks than apartments. Are there plenty of lenders that are willing to lend on mobile home parks, or is
Yeah,
that?
it's surprisingly at the upper end where we like to play, which is larger deals, better quality deals.
Mhm.
It doesn't look anything like a trailer park. The debt's pretty efficient. It's Fannie Freddie. Yeah. But the more you start going lower on the quality
Mhm.
scale and on the value add scale, and the more you start going a little bit outside of a major metro area, then you're
Mhm.
talking about regional banks, credit unions, balance sheet lenders where somebody's going to be signing on the dotted line.
Yeah.
Uh, it is more challenging, the lower in quality you go, which is
Mhm.
partly why we like to stay at
Yeah.
the upper end. But I do love the strategy of buying something that is kind of mid tier in terms of quality, that's got a little bit of hair on it, where you can add a lot of value with new capital.
Yeah.
You effectuate the business plan, and then all of a sudden that kind of iffy park is now a pretty solid park and has
Mhm.
graduated to Fannie Freddie debt
Yeah.
because you've just made that asset much more liquid. You've
Mhm.
increased your buyer pool. You're going to get paid for that. There's going to be a multiple expansion.
Nice. Now let's talk value add a little bit. What type of things do you guys do to add value?
You're right. The majority of the value adds we do are infilling some vacant pads
Mhm.
and getting rents to market and improving infrastructure.
Okay.
Right, those are kind of the three major food groups for a value add that's kind of right down the middle. Because when you think about it, what we're really offering is infrastructure. Right, when
Mhm.
we just own the land, we're giving roads, utilities, driveways, landscaping. That's really all we're offering the tenant.
Mhm.
And in exchange for that, we get our lot rent. Now, if it's in the southeast and there's a little bit of hair on it,
Mhm.
there might be more park owned homes where the owner has decided that, hey, I need to start buying some of these homes in order to support the cash flow or to bring in newer homes, right? And sell them
Mhm.
instead of selling them off, he can rent them almost the same day from a demand standpoint. But
Mhm.
selling them off and having the tenant pay for the home outright is harder to do.
Okay.
So the Southeast, for whatever reason, the model is a little bit more park owned home heavy. And so
Mhm.
there, the value add is kind of cleaning that up, getting those homes off the balance sheet long term. If there's a high percentage of them, sometimes you have to get in there with a crew and fix them up to sell them.
Mhm.
But yeah, that's a heavier kind of hairy deal.
Interesting. And when you sell them, do you guys do a lot of like rent to own type scenarios, or
Yes.
so I know it's a similar with bank financing on single trailers like that. I know banks don't like to finance those.
Yeah, there's a couple of lenders that will provide financing. It's super inefficient though, and it's very time consuming to get those loans.
Hmm.
So we will work with those banks, but oftentimes it's just easier to carry the note yourself. If it's a promissory note, you got to work with the regulators of the state, obviously. And so there's third parties that can help you with that.
Yep.
Or you can just call it a straight rental. And
Hmm.
this rent to own component, yeah, it's a part of it, but really at the end of the day, it's a rental. Nobody is kind of really thinking about these like mileage points, which some groups will do. They'll say, hey, you're accruing these points, and then when you get to a certain level, you will own the home, right? That's
Yeah.
kind of a way around the rent versus own, debate. But I think of that as a rental, unless they have paid a lot of money in a down payment, and there is some sort of promissory note that's secured, then that's a rental. No matter if they call it a lease option, a rent to own, or some sort of credit program, it's all just rentals as far as I'm concerned.
Okay, interesting, interesting. You talk about dealing with other operators and that increases your guys' deal flow. What criteria do you have for like operator experience?
Yeah, so it's interesting in that it's not as a mature market as apartments. So there are a lot of deals that come across our desk where the operator is not that experienced.
Hmm.
So that's a bit of an edge for us because oftentimes I will make an LP check, a small investment, just to test them out, kind of see how their first deal goes
Hmm.
before we will graduate them to our investment platform at Vintage Capital.
Okay.
So before we're bringing in other investors, we'll kind of give them a dry run or a test run, so to speak. And just knowing the assets and how stable they tend to be in downturns, it's a little bit easier to do that. But
Hmm.
the sponsors in our space, it's kind of a mix, right? It's a lot of two guys in a deck and maybe an asset manager, all the way up to real big businesses with
Yeah.
100-person teams and a lot of infrastructure and even institutional capital. So it's a spectrum. Because I remember how hard it was when I was starting. So
Hmm.
I love it when we get a chance to help out and invest alongside maybe somebody a little bit younger that's going their first deal into the space with the hopes that we're going to be investing with them for 30 plus years. I mean,
Hmm.
that's the dream for us.
Nice, nice, nice. Now, so there's operator experience. What about locations? Are there certain metros that you prefer or ones that you want to stay away with? How do you approach that?
Yeah, mostly red and purple states, right?
Hmm.
The blue states, especially around the Northeast, are tricky from a
Hmm.
regulatory standpoint. A lot of rent control and a lot of hurdles to evict that people that are just causing problems. And
Hmm.
it's really not even the non-payers that are the biggest problems in this space. It is people that just decide to not follow any rules,
Hmm.
and you need to get those people out of the property because they're a cancer,
They
right?
are, yeah.
They will spread that chaos among the other tenants because other
Yep.
tenants were like, hey, if this guy can do it, I can do it, right?
Same
So
thing in in
is
apartments,
it?
actually.
Yeah.
100%. Yeah.
Yeah, so that is really important to us. I frankly am comfortable investing in the Pacific Northwest where there has been recent rent control because they've just guaranteed that we're going to have no new supply, which is already kind of a feature of the space, right? It's very hard to develop in our world, but in the Pacific Northwest, is now guaranteed that there'll be no new developments, and it basically makes the lot rent increase notice pretty just straightforward. Like, hey, we know
Mhm.
exactly what the number is, and we're going to give you that number every year. So you can underwrite that, right? That's not an unknown risk. We know what the regulatory risk is now. Whereas a state like Michigan is tougher for us because
Mhm.
it feels like they want rent control, right? And they're talking about it, and the state is putting forward bills, but nothing is passed yet. And so when you're
Mhm.
looking at a deal, you're like, well, am I buying this for a rent control world, or am I buying this, for the unrestricted ability to increase rents over time? So
Yeah.
that's tough to do deals in a state like that.
Yeah. 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 Just kind of comparing, a lot of people in the apartment industry love the red and purple states and stay away from blue. So,
I mean, it's sad. It's
yeah.
it's just like, think about all that capital that is being allocated to other states
Yeah.
and what that means for the condition of buildings over time.
Mhm. Yeah. Yeah. And you live in one of the more blue states in the country right now. So,
Yeah.
yeah.
Unfortunately, I don't own anything here. So we gotta, we have to get on a plane to see anything we invest in.
Yeah. But as far as so I have a friend that runs a fund that invests in a lot of different things. But when he started doing this, he had a mentor that said, hey, you live in a money state, so instead of trying to operate apartments or operate, you probably want to start learning how to find money, because California is more of a money state, funding deals, pretty much across the country. So,
That is
but
accurate. Yeah.
yeah.
I think we did the math. Our head of investor relations did the math where our limited partners are basically 40% from California, like 30% from New York, and then like 20% from Texas, and then sprinkled out, in the other places.
We buy in Utah, and so obviously we get a lot of you always get a lot of backyard investors. So I haven't done the numbers, but I would say that picking the state where we have the most investors, it's going to be California by far. Utah's probably number two, but we've got a lot of California investors that come in
Yeah.
and fund a lot of our deals. So
Yeah,
uh,
and there's a stigma of like the dumb California investor that is the new guy in the market, right? That's making the investment. Part of the reason why Californians like are so anxious to do real estate deals out of the state is that we need the depreciation. The tax
Mhm.
benefits are so unreal in your space and in ours. We get, most of the asset is 15-year property in mobile home parks,
Yeah,
which you can now bonus to the first year.
yeah.
So most people think like, well, no, it's all land, but no, it's the infrastructure, it's the roads, it's the pipes that we talked about.
Mhm.
That's all 15-year property. And when you're kind of buying on the edges of towns, right? Because our parks aren't like in the middle of a downtown city location. So when you're buying on the edges, the land value is not super high. It's really all the infrastructure. So
Yeah.
yeah, when somebody hears that you can get, anywhere from $1 to $1.50 for every dollar you invest in losses that first year, their eyes light up if they live in a state like California where they want 50% of your money.
Yeah, big number on depreciation really helps, and that's something we have in common. We can't depreciate nearly as much, but that's definitely something the two asset classes have in common, or asset types, I think, because we're asset class is multifamily. Who cares? Who cares?
Yeah, who cares?
Um, but so talking about raising capital, any significant challenges in the capital raising environment, or all systems go? How's that been working out for you?
Oh, it's definitely not as easy as it was
Mhm.
pre-correction,
Yeah.
which honestly I prefer because that tells me that okay, if it's harder to do deals, if it's harder to raise money, like we're probably putting that money to work in good vintage years, which
Mhm.
is how I think about allocating,
Yeah.
right, to various sectors. You want to be putting your money to work when things are not incredibly hot and overheated. That's
Yeah.
just a little bit of a margin for error. It's not an exact science, but it tends to tie, right? If you think back to
Mhm.
2120, like anything that was put out there got funded.
Yeah.
I mean, just the craziest deals.
Mhm.
And I would, in 19 and 18, I would look at these deals and I was just like, we are leaving so much money on the table, but like, this is the only way I know how to do it. We never did the floating rate debt because I
Mhm.
just wouldn't be able to sleep at night because I don't know what interest rates are going to do.
Yeah.
And I would see like the unbelievable returns on some of these deals and how
Mhm.
quickly they would get funded. And I was just like, well, it's just not for me.
Yeah.
But so now it is more challenging, which is
Mhm.
just kind of like how I prefer to invest. It's more of a knife fight. Yeah. So you just got to work a little bit harder, explain more, kind of shake more trees, get out there.
Mhm.
Tends to, the good deals tend to work out still.
Nice. Yeah. And I tend to agree. I mean, Warren Buffett, everybody loves to quote Warren Buffett, and I'm sure I probably take his quotes out of context more than in context, but he said something like invest when others, be greedy when others are cautious, and be cautious when others are greedy. And that's kind of I think where we're at right now. A couple of years ago, everybody was greedy, which tells you should have been cautious. And now that everybody's cautious is the time to buy everything up. If I'm taking that in the right context, I think I am. But
Yeah, no, you are, and I think of it more just in terms of okay, so if debt is hard and equity is hard,
mhm,
and transactions are light,
down,
uh,
yeah.
okay, so that's a good time to be putting money to work. You just don't want to be putting money to work when the liquidity is at an all-time high.
Hmm. Yeah, absolutely. Well, cool, cool. Let's see. Okay, so you mentioned roughly 10 million mobile home parks in the nation.
Oh,
Um,
10,000. 10 million would be,
10,000. Yeah,
yeah,
10
10
million.
million would
Yeah.
be great.
Oh, what's three extra zeros? I mean, it's like the Fed, billion, trillion, who
Yeah,
cares,
whatever.
right?
It's just numbers.
Yeah, just a couple of zeros.
Yeah.
So 10,000. As far as acquisitions right now, we mentioned transaction volume. Is that down for mobile home parks too?
Oh yeah. Yeah. It's just starting to thaw a little bit, the transaction market.
Okay.
Uh, and to give you, something to compare it to, like in 2020, I sold 23 different properties,
Hmm.
not in 23 transactions. It was probably 15 transactions or
Hmm.
mid-teen, something like that. And that took up my entire year. And it was just it was chaos of deal flow, right? And transactions. And even during COVID, there was just way more things to do. And now there's no way. It's like, yeah, now it's kind of, we see maybe a handful of deals a month that kind of are fitting our buy box.
Hmm.
Whereas before it was, in the go times, it was 20
Yeah.
deals.
Yeah.
So yeah, it's probably 10x lower.
Now, with those deals, where are you finding pricing? And what I'm seeing in Salt Lake specifically with multifamily is I'll see the same deals, that the brokers are pushing for 6, 8 months until, somebody either comes up to the seller's price or the seller comes down to a buyer's price. What's the trend that you're seeing in the mobile home park area?
Yeah, it's similar. I think in our world, people have to kind of recalibrate in terms of the deal profile, right? Because we have our core deals are really kind of low teens,
Hmm.
and risk adjusted, that is actually very compelling. Like we did a deal in Phoenix
Yeah.
that was a 13 that I would do those all day long, right? It's like, I'm not worried about the demand in that market. I'm not worried about the price of the land, right? It should be higher and better uses. It should be a giant apartment building that's sky high.
Hmm. Yeah.
So that feels really good, right? But if we see a Harrier deal that's on the, maybe 45 minutes outside of Raleigh, an hour, that it's got some park owned homes, right? It's
Mhm.
maybe 80% occupied. Well, then we want to shoot for 18,
Mhm.
18 plus. So it's a spectrum for us, like based on the risk. And so in terms of pricing, there are plenty of deals that look ridiculous on paper going in. It looks like a four cap. But in our world, because it's very inefficient, because well, what if that operator hasn't raised rents in 10 years? What
Mhm.
if he is paying for all the water and utility bills, which plenty of mom and pop operators are? So I
Yeah.
think more about what is our year one cap rate, our year one yield. And then really
Mhm.
what I care about is where are we getting by year three? Like, can we get to a 7? Can we get to an 8 by year three? That's more what we focus on versus the year one cap rate.
Okay. Awesome. 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 Well, I mean, how about this? So similarities between apartments and mobile homes. What would you say the biggest difference is?
Ooh, that's a tough one. I would probably say, having to deal with the fact that the tenant owns their home, they have more security and they're more invested in the asset class. So honestly, sometimes you kind of think of the home as the tenant in
Mhm.
some markets because the home doesn't move. And
Mhm.
sometimes the tenant will just sell their home to a cousin or a friend in the middle of the night. And then you're like, you get a check from somebody else. You're like, wait, who is this? You got to
Mhm.
go through our credit check process and our screening. But because they own the home, they are like very invested in the community. And
Mhm.
so they are quick to
Yeah.
complain when things start going astray,
Mhm.
and they will organize if things go really astray. So
Yeah.
I don't know. That tends to not, I don't think that happens a lot in the apartment world because, they don't own the units themselves. Maybe that happens more in condos, right?
Mhm.
That's
Yeah.
probably the biggest difference.
Okay. How long does the average tenant stay? Because if they own the homes itself and they're renting the pads, I would imagine they're a lot stickier.
Yeah. So the turnover is like 2%.
Okay.
So yeah, if you think about that would be 50 years, right? But
Ah, wow.
what ends up happening once again is they sell the home to somebody else. The
Hmm.
home can stay 30-year plus,
Hmm.
right? On average is typically what happens because it costs $7,000 to $12,000 to move these things.
Yes.
So they don't move very often. And once they're kind of, tied down, skirted up, and plugged in utilities, almost none of those are leaving ever,
Yeah.
right? They will be demoed in 30 years, 50 years before they are moved.
Yeah. And I mean, multifamily, we're lucky to have a 50% renewal rate every year, right?
Yeah.
So that's considered a pretty good renewal rate. But if you guys are like 2%, wow, that's those are good numbers. So once you fill it up, you're not really, working on, new tenants I mean, you're going to be doing more renewals than anything else.
Yeah, it's not a leasing, like there's not a ton of leasing going on, right? So like getting the property manager that handles the day-to-day leasing is not the critical thing. Getting a property manager that enforces rules is really the priority,
Yeah.
which is why we love kind of, people that worked for, ex-cops, people that worked in government, people that worked in military, kind of
Yeah.
just no nonsense people. Like, look, you're not, you got your car on the lawn, you're not cutting your grass. Like, we're passing out notices and there's going to be consequences.
Yeah.
So that's more what we focus on versus, somebody that's very good at showing, very good at follow-up, very good at paperwork, right? We can handle most of that stuff from the home office. The
Yeah.
person that's on site more just needs to, make sure the vendors and the maintenance people are taking care of the common grounds and rules are being enforced.
Awesome. Awesome.
Yeah.
Well, that definitely sounds appealing there. I mean, we're with apartments, as I'm sure you're well aware, more talking to the listeners here. If you've got 100 people that or 100 unit apartment complex, every month you're probably looking for, 3 to 5 new tenants, and it's a month in, month out. It's one thing you're always doing is you're always marketing, you're always looking for new tenants, and there's a certain amount of turnover that you plan for, and you have to constantly be working at it, and
Sure.
that's one of the big grinds with apartments more than anything else is, there is a big grind, making sure that you stay full because you get move outs. So interesting. That I didn't realize it was so high with the mobile home parks. That's sounds very appealing. So
Yeah. And you can get that wrong by going to a really soft market. Like I learned that lesson, when I was buying 10 caps 10 years ago,
yeah,
which literally they were, it was easier to make mistakes
yeah.
because you're like, oh, we missed on demand. We missed on the incomes in this area. And we have more turnover than 2%, which in a real great location, that's
Mhm.
accurate. But like
Yeah.
in the boonies, it's going to be a lot higher. So in a market like that, like we were buying 10 caps, but we had such a cash flow cushion that we could weather the storm.
Mhm.
Now, the mistakes I see people do is they'll go to the boonies in
Mhm.
some middle, no name town in Iowa, and they will still buy a 5 cap, right?
Mhm.
And they think that they will be able to just deal with turnover on cash flow because every once in a while you'll get somebody will just abandon their home. And so you have this ugly thing in your park that
Mhm.
isn't being upkept because people don't abandon the nice ones. They abandon the really old ones that they weren't taking care of. So I mean, we have other headaches, right, that you guys don't have to deal with
Mhm.
if you go a little bit softer and hairier deals.
Yeah.
The other thing I'm envious of in your world is just the amount of capital that can be put to work. We
Mhm.
cannot put $1 billion to work, even if we, if
Yeah.
somebody just handed it to me, I'd be like, it wouldn't even be a good thing. We
Yeah.
wouldn't be able to pull it off. So that I am envious of. You guys have a much bigger, much more liquid market,
Yeah.
many more deals to chase.
I don't remember the numbers. I know in Salt Lake there's almost 200, like the Wasatch Front part of Salt, which is Greater Salt Lake. There's ballpark 300,000, 400,000 multifamily units,
I
and so
mean, it's wild.
yeah, it is wild. So there's definitely pros and cons going either direction, and I don't think either one's right or wrong. It's just preference.
Yeah,
Um,
I mean, that's the thing. The grass is always greener. Like
mhm.
really, people kind of fall in love with a thesis, and then they get into it, and then they're going to start seeing all the downsides, right? All the problems.
Yeah.
Like once again, there's no third party property management, so you are literally day one. You are the property manager if you can't find somebody, and you are the asset
But it,
manager too.
But if you're struggling to find a good property manager in the multifamily space, that's awesome, But yeah, there's pros and cons on several sides. We've had issues with our third property managers in a couple of areas. Just to be clear for anyone listening, very happy with our property management in Salt Lake, right? So nothing, not throwing shade out at our current property manager, but the management, and you mentioned this, you have a good manager that's staying on top of things, your investment's going to do a lot better. But yeah.
Oh, it's critical. Like right now, it is all about operational alpha, and that is driving returns from day to day operation.
Yeah.
It's not, it used to be, hey, you could just buy things cheaply and ride the cap rate compression capital markets game, right?
Hmm.
Buy low, sell high. That ship has sailed. It's the pros market. You have to make money. You can buy things kind of for a market looking price today. And as
Hmm.
long as you are a killer at operations, you're going to do quite well.
Yeah.
The hard part is that if you are just a finance guy that is, just good at Excel, and you want to try to buy a lot today, I would argue things probably aren't going to go as well. Like, because you
Mhm.
just need to have somebody on your team that has an engineering mindset and operator's heart that can
Yeah.
really drive returns.
Yeah. Well, awesome. Well, we're about out of time here, so I'm going to follow up with just a couple of questions
Sure.
that I, typically end every podcast with. So, question number one is, what's next for you?
More of the same. We are going to methodically keep buying mobile home parks and investing with our partners in delivering returns for our limited partners in this space. I just am a big believer in that affordable housing is a critical problem in the country. This asset class makes a dent. I love it when we get to add new homes to a property, increase the housing stock in that neighborhood, and provide housing for a nice local family that desperately needs it. So yeah, we hope to do more of the same.
Love it. All right. Next question. If you had to give advice to somebody who's just starting out, what would that advice be?
You're never going to feel 100% ready. Like, you're going to have to just go when you feel about 70% ready, if that, maybe 50. I remember when I bought my first deal, I thought for sure the second we closed that 100% of the tenants would mutiny and would stop paying us. And then the lender was going to foreclose on my house. And then it was just going to be this giant nightmare, right? That was the wake up at 3 a.m. feeling that I had.
Mhm.
And of course, everything went the exact opposite. It went quite well. But you never are going to fully know until you're actually the one doing it yourself. Like, I probably spent a year going in the weeds on research, which you need to do to just kind of like build up, your mindset and to get comfortable with what you're looking at. But at some point you got to stop analyzing, and you're getting analysis paralysis. So you got to either solve that by partnering with somebody that's actually seen it, or you got to take the plunge.
Yeah, I love it. I remember when I was just starting out, there came a time where I just had to say, I know enough. Now I need to start doing. It probably took me 2 years of
Sure.
books and podcasts and going to events to come up with that one. But yeah, I think you're right. 50 to 70%. If you're 50 to 70% confident, time to
Let's
go.
go. Yeah.
Yeah, let's go. All right, last question. How can listeners learn more about you?
They can go to vintage-funds.com. We have a ton of resources
Mhm.
from an education standpoint on the website. We are a big believer in educating people in this space. So if
Mhm.
somebody comes into the market and wants to start, operating and buying parks, we hope to partner with them someday. We hope they're doing it the right way. So there's a ton of resources for them, vintage-funds.com. And of
Perfect.
course, if they want to reach out and ask questions, we're more than happy to have conversations.
Awesome. Awesome. And we'll put a link to that in the show notes for anybody who's interested. That said, Brad, thanks a lot for coming on the show today. Very much appreciate it.
Yeah, Brian, thanks for having me.